When inflation rises, not all stocks perform the same. Stocks with pricing power are special because these companies can raise their prices without losing customers. Think about big brands or companies in essential industries. They sell products or services people need no matter what. This ability helps them keep profits steady even when costs go up. In 2025, investing in such stocks can protect your money from inflation. They often belong to sectors like consumer goods, healthcare, and technology. By choosing stocks with pricing power, you help your portfolio grow in value while inflation eats away less of your wealth. Always research companies that show strong demand and the ability to pass costs to customers. TAPS in inflation, protected bonds. When inflation is high, traditional bonds can lose value because their fixed interest payments buy less over time. That's where TAPS in inflation, protected bonds come in. TAPS stands for Treasury Inflation Protected Securities. These are special government bonds designed to protect your investment from inflation. How do they work? The principal value of TAPS adjusts with inflation, measured by the Consumer Price Index (CPI). When inflation rises, the principal increases, so your interest payments, which are a percentage of the principal, also go up. This means your income keeps pace with rising prices, preserving your buying power. Besides TAPS, some countries and companies offer inflation-linked bonds with similar protections. These bonds tend to be safer investments, backed by governments or reliable corporations. Including TAPS or inflation-protected bonds in your portfolio can reduce the risk inflation poses to your fixed income investments. They offer steady, inflation-adjusted returns and can balance more volatile assets like stocks. For 2025, these bonds remain a top choice for conservative investors who want to safeguard their money from inflation's impact. They provide peace of mind by ensuring your investment grows in line with the cost of living, making them a key tool to inflation-proof your finances. Real estate and REITs. Real estate has long been considered a strong hedge against inflation. When prices rise, property values and rental incomes often increase too, helping investors protect their wealth. This makes real estate a popular choice for inflation-proofing your finances. Investing directly in physical properties can provide steady rental income and potential appreciation. However, buying and managing property requires significant capital and effort. For easier access, many investors turn to REITs, real estate investment trusts. REITs are companies that own and operate income-generating real estate like apartments, offices, or shopping centers. They pay most of their profits as dividends, offering investors regular income. During inflation, rents and property values usually rise, which can boost REIT earnings and dividends. This makes REITs a flexible and liquid way to benefit from real estate without owning property directly. However, remember that real estate and REITs can be affected by interest rates and economic conditions, so diversify your investments wisely. In 2025, including real estate or REITs in your portfolio can help balance inflation risks while providing income and growth potential. They remain one of the top investments to consider for inflation protection. Dividend-paying stocks. Dividend-paying stocks are an excellent way to protect your finances against inflation. These are shares of companies that regularly return a portion of their profits to shareholders as dividends. Why does this matter during inflation? Because dividends can grow over time, helping your income keep pace with rising prices. Companies that pay dividends tend to be well-established and financially strong. They often operate in stable industries like utilities, consumer goods, or telecommunications. These businesses generate steady cash flow, allowing them to increase dividends even when the economy faces inflation. When inflation pushes costs up, dividend-paying companies with pricing power can raise their prices to maintain profits, which supports growing dividends. This makes dividend stocks attractive for investors seeking income and long-term growth. Adding dividend-paying stocks to your portfolio in 2025 can help provide a steady income stream that may increase with inflation, preserving your purchasing power. Plus, many dividend stocks have a history of resilience during economic ups and downs, offering some safety in uncertain times. Remember to research companies carefully, focusing on dividend history, payout ratios, and financial health to choose the best stocks for inflation protection. Gold and commodities. Gold and commodities have been traditional favorites for protecting against inflation for centuries. When inflation rises, the value of paper money often falls, but tangible assets like gold and raw materials tend to keep their worth or even increase. Gold is seen as a safe haven asset because it holds value even during economic uncertainty. Investors buy gold to preserve wealth when inflation erodes the value of cash and other investments. Gold can be held as physical bars, coins, or through exchange-traded funds ETFs that track gold prices. Commodities like oil, natural gas, metals, and agricultural products also tend to rise with inflation because their prices are tied to supply and demand. Investing in commodity ETFs or futures can give exposure to this inflation-proof asset class. However, gold and commodities can be volatile, and their prices can fluctuate due to global events and market sentiment. It's best to use them as part of a diversified portfolio rather than relying on them solely. For 2025, gold and commodities remain a strong option to protect your finances from inflation's impact, providing a hedge that often moves opposite to traditional stocks and bonds. High-yield savings accounts. In times of inflation, keeping your money in a regular savings account can actually cause you to lose purchasing power because interest rates often lag behind rising prices. That's why high-yield savings accounts have become a smart choice for protecting your cash in 2025. High-yield savings accounts offer much better interest rates compared to traditional savings accounts, sometimes several times higher. This means your money grows faster, helping to offset the impact of inflation. Plus, these accounts are usually safe, insured by government agencies like the FDIC in the US. Many online banks provide high-yield savings accounts with no monthly fees and easy access to your money. This flexibility makes them ideal for emergency funds or short-term savings goals where you need both growth and liquidity. While they don't match the returns of stocks or real estate, high-yield savings accounts are a low-risk way to keep your cash working for you. They're especially useful during uncertain times when you want to avoid risk but still earn more than just leaving money in a checking account. For 2025, putting your cash in a high-yield savings account can be a simple, effective step to inflation-proof your finances without taking on risk. Short-term CDs and money markets. Short-term certificates of deposit, CDs, and money market accounts are smart options to protect your savings from inflation in 2025. These financial products offer higher interest rates than regular savings accounts, helping your money grow faster. Short-term CDs lock your money for a fixed period, usually from a few months up to a year, at a guaranteed interest rate. This can be beneficial when rates are rising, as you can ladder CDs to take advantage of better rates over time. The main advantage is safety. Your principal is secure, and the interest is predictable. Money market accounts also provide higher yields and let you access your funds more easily than CDs. They often come with check, writing privileges, and debit cards, making them convenient for daily use while earning better interest. Both options are typically insured by government agencies, which means your money is safe even if the bank fails. While the returns might not fully beat inflation, short-term CDs and money market accounts reduce risk and offer liquidity, making them useful parts of an inflation-proof portfolio. In 2025, balancing your investments with these safer cash alternatives can help you maintain financial stability as prices rise.